So our first topic is cost of capital. Now, what is cost of capital? Cost of capital is basically the cost of raising finance. So in order to estimate the cost of capital, first of all, we should know that how an organization raises finances. So as far as the sources of finance is concerned, let's assume that I am talking about a public listed entity, and public listed entity wants to raise long-term finance. So long-term finance can be raised via ordinary shares, that is classified as equity, or we have option that is called debt finance. In between, you can add preference shares as well. And as far as the debt finance is concerned, debt finance is fixed income securities. So you can say that tradable debts versus non-tradable debts, such as simple bank loan. Now, as far as the different financing is concerned, when investor invest money into your business, the investors wants the return on their investment. And as far as the return on investor is concerned, it's directly related with the risk of investment. And remember this rule that higher is the risk, the higher will be the rate of return. Now, as far as the different types of financing is concerned, that each financing has different characteristics, return abilities. So as far as the cheaper source of finance is concerned, debt is classified as cheaper source of finance. And ordinary shares are considered as the most expensive source of finance. Now, what is the reason behind this, that ordinary shares is considered to be the most riskiest type of investment? The reason is that the return by ordinary shareholder is not fixed. The return of ordinary shareholder is not fixed, and usually the ordinary shareholder get the return either in the form of dividend income or in the form of capital gain, or both. But this capital gain might result in capital loss as well. This is a risk, that there might be some appreciation in share price as well as some fall in the share price. Similarly, dividend is not a compulsory payment, depends on the discretion of the directors and other factors. So it means that the shareholder will get anything depends on the availability of company's profit and the positive outlook of the company in the stock market. And as far as the payment is concerned, in terms of the bankruptcy, the shareholder in the creditor hierarchy comes in the last. When a company gets bankrupt, the shareholder will get their share at the end of all the finance providers. So it means that there is a minimum chance that they might be able to get something. So as they are taking this much of risk, so their return must be high enough in order to persuade them to put money into the company. Now, why debt is a cheaper source of finance? The reason behind is that from the investor's point of view, the interest is compulsory. Number one reason, interest is compulsory. Next is the debt is having a prior right. Means in case of default, the debt holder will get the money first, then preference shareholders will get the money at the end, the ordinary shareholders will get the money. And another reason which makes that financing much more cheaper is the interest expense is an allowable expense from the company's point of view. It's tax allowable expense. What it means and how this point created further cheaper. The reason is that when you prepare taxable profit and loss account, and interest is an allowable expense, but dividend is not an allowable expense. So if interest will be charged as an expense, it will reduce your taxable profit. So if suppose my cost of debt is suppose 8%, but after tax, suppose 30% is the tax rate, my cost of capital, my cost of debt would be 5.6%. Means my commitment is 8%, but due to tax advantage, I have to pay 5.6%, or I will get the impact as 5.6%. So as far as the return is concerned, you can say that the cost of equity, that is the shareholders required rate of return, is always greater than cost of preference shares, and this is always greater than cost of debt financing. So preference shares are in between. So it might be like that if cost of equity represented by K is 12%, KP is suppose 10%. So debt might be lower than this, and suppose debt is 6%. Now question is that how we can estimate cost of capital. So the point is that company normally use multiple mix of financing. Company is not use the 100% equity or 100% debt. Rather, company create a mix of financing, and that mix of finance includes ordinary shares, preference shares, debt as well. So in order to calculate that how much is the cost of capital, we have to find out average cost of capital. And for average cost of capital, this is called the weighted average cost of capital, we have to find out the value of capital or weightage of capital in order to find out the average cost of capital. So suppose the individual cost is given, or I have already calculated, then I need the weightage of equity, weightage of preference shares, and weightage of debt financing. So suppose the weightage of equity is 60%. The weightage, or you can say value, it's 10%, and weightage of debt is 30%. Now, what is the average cost of capital? So you have to use the formula, that is weighted average cost of capital is equal to cost of equity multiplied by weightage of equity or value of equity. Similarly, cost of preference shares multiplied by weightage of preference shares. You can also use W against this, and cost of debt against debt. Now put the figures. We have 12% into 60%. Then we have 10% into 0.1. And similarly, we have 6% cost of debt into 0.3. So what would be my weighted average cost of capital? Although the equity is 12%, but this average make it somewhat reduced amount. So it's 1 and it's 1.8. So my weighted average cost of capital is 10%. Now you see, this weighted average cost of capital depends on the component of each financing. If you put more debt financing, as we can say that that is a cheaper source of finance, so it means that your average cost of capital might go down. And if you can use the highest amount of equity, then it might be possible that your WACC might increase. So what we want, what is our objective? Our objective is to maximize the wealth of shareholder. And in order to maximize the wealth of shareholders, what we need to do? The shareholders' wealth is the present value of future cash flows. So we need to minimize the cost of capital. Now it's up to you to decide that at what financing ratio my cost of capital would be minimized. We'll study optimum capital structure theory against this, that what is the suitable debt to equity ratio that makes my cost minimum. If cost of the financing is minimum, the wealth of shareholder will be maximum. So the objective is now to minimize the cost of capital, to find out a optimum capital structure. What is optimum capital structure? A capital structure at which the cost of capital is minimum. This is called optimum capital structure, that is debt to equity ratio. And remember that equity is expensive and debt is a cheaper source of finance. So at the beginning, student might think that if you put 90% debt, that it will result in the overall downfall of the WACC. But this is not the case, because although debt is a cheaper source of finance, but interest is fixed, interest is committed. So you have to bear the burden of the debt.